G'day guys, welcome back to the channel. It is Crass here, back at you with another hopefully informative video that you can learn something from and apply to your investments. Guys, in this video, I'm going to be talking about something central to the Sagely school of investing, which is dividends. And one thing that we need to understand about dividends is their growth rate. And so over time, over a period of 10 years, 20 years, or 25 years, what kind of growth rate in those dividends are we going to expect? So in this video, I'm going to take you through the US stock market and the Australian stock market, take a look at what the differences are, talk a little bit about the economics, and conclude which market is better to invest in. Let's jump into the video. All right, so here I have the VTI exchange traded fund, which is traded on the New York Stock Exchange. It is provided by Vanguard and it tracks the CRSP US Total Market Index. Basically, guys, this fund is a good representation of the stocks on the New York Stock Exchange and the NASDAQ. So it represents the USA stock market very, very well. So I've got data from 2001 right up to 2019. And in this table, you can see for each quarter, how many dividends were paid, right? So taking a random one, in the year 2013, in the third quarter, a shareholder of 1 unit of this fund would have received 42.9 cents or 0.429 US dollars. We're talking US dollars here. Summing up all these dividends and then calculating the growth rate from year to year, we can then start to calculate average growth rates and then an average of an average. So to start off with, let's take a look at the 18-year average growth in dividends. What does this actually represent? Well, from a pure data crunching perspective, if we click on that, it's just the average of the yearly growth rate over the last 18 years, the 10-year average over the last 10 years, and the 5-year average over the last 5 years. The reason why I've taken the average of these averages to get a final number that we can use becomes very apparent when you look at the 10-year average of 9.2%, okay? For instance, if we take a 10-year average from 2005 to 2014, you get an average of 12% growth per year. Now, if we take that same 10-year period from 2006 to 2015, that dramatically changes to 18% growth per year. Are we going to get 18% growth per year indefinitely into the future? No, we are not. That's why we kind of tend to take the blended average of the different averages to get a more representative description of what that overall growth rate is. All right, if you guys are keeping up with me so far, make sure to leave a like to this video because you can already see where this analysis is going. This analysis is going to actually tell us how many years of growth we need to achieve a doubling of our dividend payment. That's the whole purpose of this exercise. So if your portfolio is all in VTI, okay, this is the fund we're talking about right now. If 100% of your portfolio is in the US stock market and you're currently receiving $5,000 per year, you want to know how many years until you receive $10,000 from that portfolio without doing anything, without adding or subtracting to it. The answer is 6.9 years on average. Of course, past performance is not an indicator of future performance. There is a big band of volatility around that 6.9 years. So in a very, very good case scenario, it might double in 4 years, which is pretty crazy, but it might. In a more conservative scenario, it might double in 12 years, okay? But this gives us a picture and it gives us something to kind of anchor our expectations to for the future. So this is the US stock market in US dollars. Let's jump to the ASX example, okay? So initially, guys, I first started off with one of my favorite funds on the ASX, which is the VAS. ETF. So it's traded on the ASX, it's produced by Vanguard, and it tracks the ASX 300 index. However, we only have data from 2010, so I couldn't really get very good long-term averages. So I decided to go with the State Street Global Advisors STW ETF, which basically tracks the ASX 200 index. So this is very representative of the overall Australian stock exchange and stock market. Basically, you've got a similar thing as before. We've taken the 17-year average because that's where the data starts, taken 10-year average and a 5-year average. Again, you can see drastic differences in those averages, but if we take a blended average of those, we get a growth rate of 6.2% per year. You might be wondering, what does 6.2% growth rate per year mean? Well, in theory, all it means is that if today you receive $1 in dividends, in a year's time, you should receive $1.06 in dividends, okay? Plugging that into our GoalSeek formula here, we see that by owning the STW ASX 200 index tracker, it'll actually take 11.5 years to double your dividend, okay? Right, the other example that I wanted to give you is a individual stock example, okay? So this is one of my favorite shares to invest in, SOL, which is called Washington H. Soul Pattinson and Co. It's an ASX listed company, which is basically a large conglomerate of smaller companies. So when you invest in a company like Sol, you're really just investing in the management experience, okay, and the management's vision for the future and their ability to outperform the market. And as we can see that from 1998 through to 2019, I have a lot of data from them, and we can see that on average they have managed to grow their dividend by 7.8% each year. So that cuts down that doubling factor from 12 years for the ASX to 9 years if you had invested in Soul Pattinson. All right. So what does this mean for us as investors? If you guys have made it this far through the video, I really appreciate it, because now I'm going to give you the conclusion, or at least my conclusion and my summary. Let's go to the summary tab. So what have we actually learned from this analysis? What have we actually understood that we can take away and use for our own investing? Well, here it goes. Let's ease into it, okay? So basically we're looking at the US stock market versus the Australian stock market. We're looking at two different investment vehicles. One is called VTI, which I covered at the start of the video, and the other one is called STW. To recap, the average dividend growth year on year from the US stock market is 10.5%. Contrast that to 6.2% from the Australian stock market. So that results in, on average, 7 years to double your dividend income from the US stock market and 12 years to double your dividend income from the Australian stock market. A big disclaimer here, okay? I haven't taken into account taxes, and I haven't taken into account things like franking credits, okay? I think that would have just made the analysis a little bit too difficult and time consuming, so this is a pretty high level analysis, which will probably apply for most investors. Now, why do we see these differences between the US and the Australian stock market? Well, I researched a lot of different sources here, and I will place a link to them below. Now, big difference in the historical average dividend yield between the US and Australia. In the US, we see 2% dividend yield on average and 4% in Australia. A very easy way to explain that is the big difference between the interest rates between Australia in the grey line here and the USA in the red line. So historically, Australian shares had to compete with quite a high interest rate, risk-free interest rate in your bank account. Look at this, 2011, we had an interest rate of about 4.5%, 5%. Why would you buy shares when you can get 4.5%, 5% guaranteed every year in your bank account? Whereas in the US, you couldn't get that. That drove the prices of shares up a lot higher in the US, and it reduced that dividend yield to 2%. This is one explanation, as we'll see. Next, historically, Australian shares have had a much higher dividend payout ratio of 70%, contrasted to about 40% over in the US. If we look at this graph here, the last 10 or so years, 40% for the US and about 70% for Australia. Now, why is this? Well, there's good reasons behind it. I don't really want to get into it, but this kind of also explains why we see this larger dividend yield from Australian shares, because they pay out more in dividends. So if that's the case, then what are the US shares doing with the money that they're not paying out in dividends? Well, they're actually buying back more stock. So rather than return money to investors by paying dividends, the US companies, for one reason or another, probably for taxation purposes, have decided to ramp up their stock buybacks. Okay, so they typically buy back 2 to 3% of their outstanding shares every year, whereas in Australia it's only about 1%. And if we look at the interest rates, we can understand why this makes sense, because over the last 10 years, interest rates in the US have been very low, thus making it very easy for companies to borrow capital and then buy their own shares, inflating their share price, increasing their dividend yields, and so their executives can get bigger bonuses. Okay, I'm being a little bit facetious here with that, but anyway, moving on to the most interesting thing that I discovered, that 1/3 of growth from the US historically has come from population growth, whereas in Australia, population growth has contributed 2/3 of growth in the stock market. The US has much higher productivity than Australia, and what we find is that this fact here, for one reason or another, could be due to government red tape, could be due to a tech stocks taking off over the last decade. I don't know, but it has resulted in better performance in the US markets, especially since the global financial crisis. If you look at how much the US stock market has gone up since the GFC, it's destroying the Australian stock market. Okay, whether that continues into the future, going back to past performance is not an indicator of future performance, I don't know. So the conclusion for me is that keeping everything the same, going forward, the US stock market presents a better investment opportunity for investors, because you can double your dividends much faster than here in Australia. Point number 2 is that, dividend investing will make you very wealthy one day. And if you stick to it, if you're consistent and you don't get led astray by other people's opinions about where you should be putting your money, and you stick to your dividend investment strategy through low-cost index funds like VTI, STW, and VAS, you'll come out on top. I'll give you an example right now off the bat. If you invest $250,000 into the stock market today, you should be receiving about $10,000 a year in dividends at a 4% dividend yield. That will turn into $20,000 in 12 years' time, into $40,000 in 24 years' time, without you doing anything. In my example, my personal example, I'm 31 years old now. I am targeting to try and invest $1 million into the stock market by the time I'm 36. That's 5 years from now. I want to have a portfolio worth $1 million 5 years from now. That will be paying me about $40,000 a year in dividends. In 12 years' time, it'll be $80,000, and in 24 years' time, it'll be about $160,000 if I don't even add anything to it. And from age 36 to age 60, if I don't add a single cent to my portfolio at age 60, which is 24 years down the track, it will pay me about $160,000, give or take, right? Give or take. So this is the power of dividend investing over time, guys. It is phenomenally powerful. If this hasn't convinced you why you should start investing in dividends today, I don't know what will. Maybe I need to start making more videos with Ferraris and Lamborghinis in the background. I don't know. You guys let me know. Let me know what you think. If this has broken it down to you to make it really clear and now you have the confidence to start investing in the stock market, let me know. If you still need more information, let me know what that is, because I'm trying to build a business here to help people invest better. Guys, if you haven't left a thumbs up yet, what are you doing? You've come to the end of the video. Leave a thumbs up, subscribe, and spread the word about my channel. Really appreciate it, guys, and see you in the next video.